Welcome back to today's Explainer. It's July 19th, 2026, and we're diving right into the SASB sustainability standards for the real estate services industry. Specifically, we're unpacking the 2023-12 version to look at some accounting metrics that, honestly, go way beyond just dollars and cents.
I mean, think about it. How do you actually measure something as invisible as trust? Sure, the real estate business is built on physical things, concrete, steel, land, but the whole business model fundamentally relies on client trust and loyalty. So, how do you quantify a conflict of interest? Well, that's exactly what these SASB standards do. They literally turn that invisible currency of trust into tangible, reportable data.
So here's our roadmap for today's Explainer. We'll start with the currency of trust, move on to defining dual agency, and then break down tracking dual agency revenue. After that, we'll hit risks in appraisal services, reporting appraisal revenue, and wrap up with safeguarding integrity. Let's get right into it.
Section 1. The currency of trust.
If you look at the official SASB disclosure topics, the specific area we're analyzing today is transparent information and management of conflict of interest. You know, in an industry with so many different services and sometimes thousands of professionals under one roof, managing conflicts isn't just checking a compliance box. It's an absolutely crucial governance issue. Maintaining sky-high ethical standards is literally what keeps those long-term client relationships alive.
Which brings us to Section 2, defining dual agency transactions.
The standard is super precise here. A dual agency transaction, or what some folks call dual representation, is exactly what it sounds like. It's when a firm represents both the buyer and the seller in the exact same real estate deal. You can probably spot the inherent conflict of interest from a mile away, right? Because how do you aggressively negotiate the absolute highest price for the seller while at the same time fighting for the lowest possible price for the buyer? It's a massive balancing act, and it takes immense professional integrity to pull it off without being negligent.
Section 3. Tracking dual agency revenue.
So, how do we actually track and report the money flowing from these dual agency deals? Well, SASB gives us a very strict rule of exclusion to make things hyper-clear. When calculating revenue from dual agency transactions, you only include your direct real estate sales brokerage revenue, period. So, say you brokered the sale of a massive office building, and then they hire you to be the property manager. You have to totally exclude that property management revenue from this metric. You also exclude leasing, insurance, appraisals, the whole shebang, as long as it's not that direct sales brokerage fee. We are looking for a completely pure, undiluted number here.
And this gives us our official ANCA for compliance reporting, metric IFRS 510A.1. It's a quantitative metric reported in your presentation currency. By sticking strictly to those inclusion and exclusion rules we just talked about, you're giving stakeholders a standardized, crystal-clear view of your firm's actual exposure to dual agency risks.
Now let's pivot to Section 4, risks in appraisal services.
SASB defines appraisal services pretty simply, the act or process of developing an opinion of value. But don't let that simplicity fool you. Appraisals lay the entire foundational value of a property. Every single decision that comes after, whether that's financing, buying, or developing, rests entirely on that one number. So if your firm provides the appraisal and then also stands to make money from the subsequent sale or financing of that same property, yeah, the risk for bias or negligence absolutely skyrockets.
Section 5, reporting appraisal-linked revenue.
This is where tracking the revenue gets to be a bit of a balancing act. You are actually not reporting the fee you charged for the appraisal itself. I know that sounds a little counterintuitive, but let me repeat it. Exclude the direct appraisal services revenue. Instead, what you must include is the revenue generated from other transactions on that exact same property. We're talking brokerage services, financing services, consulting, or market analysis. You also leave out property management. The whole point here is to show stakeholders exactly how much money your firm made off a property after you were the ones who established its baseline value.
Which ties perfectly into metric IFRS 15A2. Just like our dual agency metric, this one is quantitative and reported in your presentation currency. Now here is a crucial detail. You have to report this associated revenue regardless of when the actual appraisal took place. No joke. Even if you appraised the building 3 years ago in a totally different reporting period, if you are making brokerage or financing revenue on it today, it has to be tracked under this metric.
Moving into our final part, Section 6, safeguarding professional integrity.
So how do firms actually manage these risks to protect their brand? Well, to mitigate any perceived or actual conflicts, whether in dual agency or appraisals, the SASB standard pushes for radical transparency.
Firms need strict policies that require disclosing any material real estate issues. You have to clearly identify who the transaction counterparties are. You need to lay out fiduciary duties in black and white, who represents who, and where exactly the loyalties lie. And for appraisals, you've got to reveal if any related parties did the appraisal and clearly state all your fees and contingencies.
But having transparency on paper just isn't enough, right? It has to be put into practice. The standard outlines specific steps to make sure your workforce actually maintains that duty of care. Step 1, you have to actively notify employees about your ethics policies. Step 2, run regular compliance training. Step 3 is a big one. You must implement safe internal reporting mechanisms so people can actually flag ethics concerns without fear. And Step 4, strictly enforce the rules through real investigations and disciplinary action. You can even disclose how these policies apply to your external business partners.
Because honestly, if you fail to manage these conflicts, the consequences are incredibly severe, and they are public. Metric IFRS 1510 A3 requires you to report your total monetary losses from legal proceedings tied to professional integrity. We are talking negligence, malpractice, fraud, corruption, bribery. That means civil judgments, regulatory penalties, and criminal restitution. And by the way, this is the actual cash loss. You do not get to deduct your legal defense fees from this total. You also have to describe exactly what happened and what corrective actions you're taking to fix it.
At the end of the day, this is exactly why these guidelines exist in the first place. We've gone over all the exclusionary tracking, the deep dive disclosure requirements, the quantitative codes. But taking a step back, these dry accounting metrics are actually your firm's most powerful tools for protecting its core asset. Think about it. Inadequate risk management destroys your market share and practically begs for regulatory fines. But effective risk management, it actively builds client trust, boosts your brand value, and really drives that long-term revenue growth.
So I'll leave you with this to chew on as you look at your own data. When you compile these metrics, what narrative is actually emerging? Are your compliance metrics telling the market a story of unmanaged risk and hidden conflicts? Or are they broadcasting a story of unshakable client trust and rock-solid professional integrity? Try viewing your SASB reporting not as some annoying regulatory burden, but as a strategic advantage to prove just how reliable you are. Thanks so much for joining me on this explainer, and keep learning.